Well, my name is Shatajanand, and today we have with us a very special guest, Pranav Parikh, who's a managing partner and head PE at Nuvama Asset Management. Welcome to the show, Mr. Parikh.
Thank you so much, Ritesh.
Thank you so much for taking time out, Pranav. Now we are, doing the AIF talk, and alternates is has emerged as one big area which industry is focused on. So, what are
So,
alternates, and how do they help in comparison to the other channels of bridging the funding gap?
absolutely. Thank you again, Ritesh, for this. It's absolute pleasure to be here. Um, the easiest way to think about alternatives is actually think about this as a non-traditional asset class that
Right.
goes beyond what we are all used to, which is pure liquid public equities, publicly listed bonds, and think about cash, right? I mean, if you just take away all these traditional asset classes,
Hmm.
gold, etc., then you get into what is called alternatives, and this is now a defined term that everybody uses globally.
Hmm.
Um, s- Over the last 20, 30 years, it's kind of gained prominence in a lot of portfolios. It started with a lot of institutions really embracing this as a way to diversify, lower the correlation to their other asset classes, and hopefully do better returns. And if you actually see the history of alternatives, I think it's proved to be a good, diversification, lower correlation, higher return asset class over a period of time. What does it include? I mean, it includes typically private equities, part of it, you
Right.
know, different forms of hedge funds, right? Where the hedge funds take more than just a long only bet, right? Is part of it. I think real assets, right? I mean, you see infrastructure funds, you see, credit funds, anything which is not plain vanilla investing is what I think comes down under alternatives. And like I said, the special attribute is it does provide diversification. It does have a potential for higher, what we call risk adjusted returns, right? Because everything in the investing world tends to be looked at from a risk versus return perspective. And the
Hmm.
idea of alternatives is actually to bring that element of risk adjusted better returns in there. It has now in India, for example, we have stuff like, venture debt. So this is no different than, when you started, earlier we used to call lending businesses. Now
Hmm.
lending itself has so many different components. You'll have a housing
Hmm.
company, you'll have a fintech company, you'll have MSME lending. So like no different. Investing has become a lot more nuanced, and these nuances mean that not one solution will fit everyone,
Right.
and therefore you need specialized managers, specialized skills to do
Hmm.
certain things. So private equity is very different than public equity. Stressed special situations credit investing is very different than normal lending to large corporates, etc. And that's what's really alternatives are defined as. Venture debt, for example, as what it is today, is a new form of
Hmm.
investing in early stage companies, for example, providing debt.
Absolutely. No, good that we've discussed, alternates in a broader manner, and good that you touched upon the, venture debt part. We would also would like to know that, what are the things that are included in this category, the venture debt?
Yeah. This the idea here is it started a long time ago. It's actually the US has been doing this for a long time. In fact, so the idea is that, traditionally when you think about debt, usually you think about cash flows, you think about earnings, you think about ability to repay debt, you think about interest coverage, right?
Hmm.
The idea is that, at some point in time, usually in India, debt is typically taken at some, either you have a very high real asset or you have a very good collateral that you have to put up. So if you
Hmm.
were to go out and just take normal traditional bank debt, they'll ask you for आपका घर है, आपके पास real assets है, what
That's
have
right.
you, to be able to put as collateral. And it's a lot of collateral based financing. It's not really financing the cash flows of the company necessarily, although it is a core part of it. But when you go a little earlier in the stage life cycle of a company, let's say you go to startups, right? I mean, they may or may not have cash flows that can sustain a normal form of financing like debt. That is where venture debt comes into play. That's
Right.
it's called venture debt because it comes at some what is called the venture capital stage.
Hmm.
Think of this as senior secured lending to the early stage firm. Usually, it is backed by some form of equity financing by a institutional shareholder in
Mm.
there. And the idea is it's one of the earlier forms of credit that the company gets used to, right?
Right.
As the company grows, it could be used for various forms and formats. People will use it for growth, like marketing, capex,
Mm.
acquisitions. The idea is also it helps you minimize the dilution, because in the early stages of building a business, when you require capital, you need that capital. Now every time if you raise equity, you will keep on getting diluted. So
True.
this idea of venture debt is to help you get the capital that you need to a certain extent without getting very high dilution, right? And so you can use it for various reasons. That's what venture debt is all about.
Right. Now, in fact, we would also like to touch upon now that you've explained the venture debt part of it. What is the kind of return a venture debt fund could potentially generate, and also what is usually the structure that is usually deployed?
Sure, sure. Think about it, right? I mean, if you again look at investing over across different stages of a life cycle of a company, right? You have investments that happen in early stage, you have investments that happen in the growth stage, you have investments that happen in late stage in companies, then you have
Right.
investments that people do in the listed market side, right?
Mm.
um, as you can imagine, the risk that you take differs across different stages. If you talk to a public
Mm.
market investor, and let's say you went to a normal, let's say, what is the long term return that you would expect from a public market investing, for example, people were somewhere in that 12 to 15%, given the current interest rate
Mm.
environment, that you would expect some form of premium to the current risk-free rate, and that should be in that 12 to 15% on a sustained basis.
Right.
Now you have to factor in that you are coming in venture debt in an early stage company, and then on top of that you are coming in a privately held enterprise, right? So when you add that risk, I think that normally you would say that, look, it has to
Mm.
justify the risk that I'm taking, and therefore the
Yeah.
expectations are a little higher. The way these expectations are met, and that number could be anywhere from 18 to 22 or more percent.
Mm.
That's kind of general perception of where the returns should come out, because anything less than that will be will may or may not justify the risk, especially the given interest rate environment that we are in,
Mm.
right? I mean, रिस्क फ्री आपको आज सेविंग में शायद 7%, 6.5-7% मिल जाता है,
Absolutely.
राइट?
Yes. Yes.
पब्लिक मार्केट में आप 12-14% एक्सपेक्ट करते हो इन अ वेरी लिक्विड एनवायरनमेंट. So then you will add on all of this risk and say, look, itna to banna chahiye, otherwise, what is the point? And the way these are structured are typically, these are in some form of, typically these in form of securities. They're
Mm.
typically in form of NCDs that the company takes. And then usually there is some upside element. So the idea is that there is an alignment of interest
Mm.
where you say, look, I'll give you debt at a
Mm.
relatively cheaper value, because
Mm.
if I give you a very high cost debt, it may be
Mm.
not be relevant for you, or you may find it very expensive. But why don't we do some debt? And then we all want to obviously get the appropriate return, but let's align this return with your equity upside. So if you grow as a company, give us some equity upside that can make sure that we get the returns, and you are okay with it, because ultimately your fixed cost of capital is low,
Right.
but then you give a little bit upside out, and it's far better than any equity form of financing, because in equity, Kshitij, once you give your equity, you've given your
Yeah.
equity
You're
forever,
giving it. Right.
right?
You're given
या
the whole.
या आपने अगर किसी को 10% इक्विटी कंपनी की दे दी, तो वो दे दी.
Right. Right.
That's not coming back for a long term. Here, at
True.
least, it's capital you can repay, and
Mm.
you are, even if you've given some upside through warrant structure or some other structure, it's a
Mm.
very small number compared to the actual equity that you would give. So it's a very anti-dilutive type of a structure that exists.
Absolutely beautifully explained, Pranav. In fact, anyone who's a budding entrepreneur as well as investor who wants to sort of invest in the venture debt, I think this is the best session that you can, or your best 20 minutes that you can really put down and listen to, because it will help you get an idea as to what exactly goes on behind the scene, and how you can actually take advantage of venture debt if you're an entrepreneur as well as if you're an investor. Now, we've talked about what are the things that are included in the category. We've talked about the kind of return venture debt can generate. Also, why does the current market environment makes venture debt a compelling proposition?
Yeah.
Is it the new Shark Tank? You could say that.
No,
That that's
a lot.
how the current audience would sort of want to relate
Yeah.
to.
No, no, no. In fact, not at all. Not at all. In fact, if anything, this is one of the most shareholder-friendly structures out there, to be honest.
Okay.
And it's in fact very interesting because this is venture debt is one proposition that
Mhm.
I don't know if you know, but is actually very well backed and promoted by the shareholders themselves, right? So this is like if you go to any venture capitalist of in there, they will actually proactively propose this as a
Right.
solution to their portfolio companies because it also reduces their dilutive impact. It allows them to say, look, take it at a time when this is not going to be a detriment to your enterprise. So
Okay.
don't go and take venture debt when it is not appropriate, when you think you'll get into trouble, right? This debt is not expected to be your normal leverage that if things don't go wrong can actually pull you down. That's not the idea at all, right? This is think of this as a part replacement of the equity that you will raise, right? And I always give this example. Let's just, for example, say that you are looking to raise 300 crores. I'm just making this up.
Right.
And
Right.
you're looking to raise 300 crores at a 1,000 crore valuation, right?
Right.
You are willing to give up 30% of your equity. Please understand that 30% dilution impacts every shareholder, right? All VCs, everybody, founders, promoters, whatever you want to call it, shareholders, everybody gets impacted by that dilution, right? Now, instead, if we come in and say, look, instead of giving 30% up, why don't you only give 20% up, right? And take 100 crores as your venture debt, for example, right? It gets you the 300 crores that you're looking for.
Right.
It reduces your dilution by a fair bit of amount, and it's not maybe 10% because on that we'll also take some warrants, so there will be some dilution. It will be minuscule. It will be 1/10 of what that 10% would have been, right? And therefore, that 10% that you saved could be worth materially higher number over the next 5, 7, 10 years for you than giving it up now. So it's a structure that shareholders, including venture capital investors, love. It's a very shareholder friendly and therefore founder friendly structure, right? But it should be taken at the right time when you know that, look, you have the right amount of equity cushion so that this doesn't become a burden on you, that you have the ability to pay it back, because this is also your early company's early entry into this credit cycle, right? This is the first time you are probably trying to take debt, and whatever you do with this is how your history is going to be built. So you have to be very careful with it. In the current scenario, I think when people require capital, when the capital equity capital is very expensive, like you said, people wanting to take their flesh, their part of the flesh during this downturn, if you may want to call it, in funding in certain parts of the market.
True.
I think this can be a very welcome capital to the cap table, to the capital structure. There is strong demand, as you can imagine. जहाँ पे equity expensive हो गई है,
Yeah.
वहाँ पे any other alternative form of financing which reduces your dilution is very welcome today. So it is very helpful. It is also very interesting because there is a very strong demand for very special use cases like acquisition financing that is starting to come in, right? Because normal debt may not give you that opportunity. Not everything want to be financed through equity. And therefore, if you have to take such things, I think there are very good use cases that we are seeing, such as acquisition financing, that people are starting to use this for. And
Absolutely.
by the way, in this environment, you can imagine a lot of companies who are well off are trying to say, can I do some tuck-in acquisitions? Jab, when the valuations are low, then
Absolutely.
can
Yes.
I just add? So for such things, I think there's a very compelling reason to look at venture debt.
Right. Now, beautifully explained, Pranav. Now, also, where is this industry headed probably in the next 5 years? And the startup culture is beginning, not beginning to do it. I think it has already picked up pace, especially here.
Absolutely. Yeah, I think today the industry is sub $1 billion today
Mm,
in India. It's only about 3 to 4% of the venture capital industry, right? And as you know, just the venture funding in this country keeps on going up, right?
right.
We think it's a 10 to 15 times this size that we
Mm,
can probably over a longer period of time we can get to.
mm,
Because there are two things that are playing out. One, the venture investment in this country, early stage investment in this country is growing,
right.
and second, we are only about 3 to 4% of the overall industry today as venture debt. So for every 100 rupees put in venture equity, we're only 3 to 4 rupees of venture debt. Globally, especially in the US, tends to be between 15 to 20%. So if
Okay.
you take that view that in a capital starved nation like us, if the
Mm,
supply exists, then this will be taken up. Then I think this can be a few $1 billion industry, at least 5x or more in a shorter period of time. Is how we think
right.
about it.
Well, that sounds really encouraging, as well as, I'm sure a lot of our entrepreneurs would be really happy to know that. Apart from that, you definitely put in money, and I'm sure you take all the diligence before you give out the venture debt. So, what are the risk management practices followed by the fund?
Yeah, it's a very important question. That one good part about institutional investors like us, you
Mm,
can broadly divide investors into multiple categories, but we are one of the institutionally held investment firms, right? As you
yes.
know, Nuvama is a large institution, publicly listed entity with various businesses, and therefore our governance standards will also kind of be at a level which is not necessarily the same as, let's say, I was starting my own fund. My
Mm,
risk management practices versus the large institutional management practices will always differ.
absolutely.
Ours is a lot more granular. So we have a three-tier governance, risk governance structure.
Mm,
It's typically the team itself. Obviously, we have our own
mm,
risk management framework that we use. We have our own risk teams that sit outside our investment team at the corporate level. And then
mhm.
we also have an investment committee framework that a lot of other people do to look into it. So we have a three-tier risk management structure. Typically, we will, like everybody else, will employ various levels for risk management, right? You will have diversification is your best risk
Mm,
management tool that is available to all investors, and we use it extremely scientifically, if you will, if you ask me.
mm,
Um, Controlling the duration of the debt that we take, making sure that we have the right security package for the debt,
mm,
making sure that we understand the company and the cash flows very well.
mm,
This is a very, you have to understand businesses here to be able
mm,
to do a good job, and I think we come from that background, so it's relatively easy for us. And then I think as importantly, making sure that we engage with the company not only at the time of investing, but post investing management becomes very, very critical. So those are the ways we kind of risk manage.
absolutely. In fact, finally, why venture debt is actually a good option for Series A startups. If you can just highlight
I
few
think it's
examples as well.
I think what happens is when you are a Series A, Series B company, you are at the very early stage of starting your growth journey. And what is happening,
Mm,
Kshitij, in this
true.
country, in fact, globally, as you go from being a smaller economy to a very large economy,
Mm,
the amounts that you require and the dilution impact is high, right?
mm,
So controlling your dilution early on can effectively lead you to a higher shareholding as you grow. Otherwise, what happens is, you lose. I mean, by the time you raise your third or fourth or fifth round, you are sub
mm,
10% ownership. Then it
right.
impacts not just the founders, but
Mm,
shareholders, the company, everyone, because then where is this drive
yeah.
to increase value, right? If your ownership goes down. So this is a great tool for people to manage their dilutive impacts very early on in the game.
Right. I think the example that you've given that if you want to raise money, 20% you raise it from, and the 10% you raise it from venture debt, because the 10% could actually be worth of value in the next 4 to 5 years. Right.
Yeah, and retention of stake, right? I mean, you are retaining that much to yourself.
Right.
So it's a very shareholder friendly structure.
Right. Absolutely. Beautifully explained, Pranav. And on that venture note, thank you so much for your time, Mr. Parikh. And that's all for now. But do stay log on to ET Markets live stream for more on investment and trading ideas. Thank you so much for your time, sir.
Thank you so much.